accommodative or even neutral monetary policy over the coming months.
Priya, the talk in the market is now non-negligible risk of zero cuts 2024. Of course, we overreach. That's what markets do. They overreach. They become too exuberant on the bid or the offer. How real is that risk, and how real at all is the tail risk of a rate hike? And what would that do to the bond market?
So I think if you listen to Fed officials, there's really nobody talking about rate hikes.
Just
but
Larry
I
Summers.
Get concerned. I do get concerned that if the market starts to price in absolutely no rate cuts this year, then you should put in a probability that they might hike. So I think that's why it's important. Where do they cut in June, July, September? Actually, it doesn't matter all that much. Do they cut at all? I think that's the question. One of the things I'm also keeping a very close watch on is wages. You know, we know service inflation is sticky. We know service inflation is extremely linked to wage inflation. Despite these very strong payroll reports, we've had wages actually continue to moderate. The supply side of the labor market is helping equalize the fact that you've had these 250,000 payrolls and yet wages are moderating. If wages continue to moderate, and we're seeing 0.3, 0.4 month over month, I think, and I would say inflation expectations remain anchored, which have been remarkably anchored, I think the Fed can still guide towards rate cuts. Maybe it's 2 instead of 3 or 1 instead of 2. I think that actually matters less. If you do start to see the Fed starting to talk about no cuts, then I think the entire soft landing narrative is at stake. So, you know, I think we always struggle with the economic outlook or the reaction function. I think the economic outlook is giving us a mixed picture. Mike talked about it. Winnie talked about it. You look at the details, parts of it are heading lower, parts seem bumpy.
Okay.
But let's now see the reaction function. So far, I think the Fed's saying we're at restrictive territory. Let's start the process of normalization. As long as they continue to say that, I think we'll price in 1 or 2 cuts this year or 1 cut this year. And I think then the soft landing thesis can persist.
Well, that supercore needs to really, really roll over. My favorite line of the day is from RBC. The rickety dam holding back the no landing narrative may be at stake. So we'll convene again in a month's time and do it all over again with a little bit more data and insight. Priya Misra, Winnie Caesar, my guest this morning on the ECB and the bond markets. Coming up, tensions heat up in the Middle East. Oil prices jumping nearly 20% in 2024. That conversation next with Will Kennedy on Bloomberg.
We also want to address the Iranian threat to launch a significant, they're threatening to launch a significant attack on Israel. As I've told Prime Minister Netanyahu, our commitment to Israel's security against these threats from Iran and its proxies is ironclad. Let me say it again, ironclad. We're going to do all we can to protect Israel's security.
Oil is swinging near the $90 mark. That's after a pretty tough couple of sessions. We're preparing for a whole host of functions. Traders are watching as the U.S. warns of a major attack on Israel by Iran or its proxies. Global tensions have driven the oil market up 18% this year. Will Kennedy joins me now. Well, the market has rolled down since you and I caught up this morning. We don't know what the response mechanism will be from Iran. Is that, along with a tight market, driving this market? How comfortable is OPEC with these prices? Good morning.
Hi, Manus. Thanks for having me on again. I think the market is characterized exactly like you say, by tight fundamental supply and demand, a strong economy, especially in the US, which is driving demand higher, combined with some tight control of the market from OPEC and some other supply disruptions around the world. And on top of that, you've got a layer of political risk. And that's really what's driven this rally, which, you know, if we think back to the beginning of the year, very few people in the market foresaw. There was a real bearish mood in the market, but we've seen, as you say, a significant rally. So it's that combination of the two. What happens from here? You know, there will be a lot of concern from traders that this situation between Iran and Israel, while it isn't currently a threat to any production, and the war in Gaza hasn't taken any production out of the market, although it has disrupted shipping in the Red Sea, is that it escalates to a point where Iran gets drawn into a regional conflict and there is some impact on oil exports from the Gulf region. But I would stress that that's a long way off, but it's a risk that the market does need to be aware of.
Indeed, and as you and I said this morning, the reaction function from OPEC Plus in June will be all the more pressure. And indeed, they all have the capacity, not all, but certainly Saudi and the Emiratis, along with a number of others, have the capacity to add back pretty quickly. Well, thank you very much for joining me this morning. That is Will Kennedy on the oil market. Price action going on in these markets. Katie Greifeld is on set. Katie, what have we got?
Well, it's a pretty even split if you take a look at the sector level right now. You have 5 sectors in the green, 6 in the red. Leading the way to the upside, you have communication services and tech, of course, up about 0.6% a piece. You take a look at what's not doing too well. You have energy, you have healthcare, and then you have real estate. Real estate down by about 0.2%. Financials leading the way, rather, to the downside. But let's talk about real estate, because this is part of a trend here. Real estate is your worst performing sector on the week, as you can see right there, over the past 4 days, off by more than 2%. Of course, really interesting moves in the bond market as well. Perhaps that's working its way into the real estate sector, Manus.
Katie, thank you very much. Coming up, the market moving events to set your clock by, the trading diary on the way. We've managed to put a little bit of calm into these markets. Nasdaq rebounded by 0.4%. Again, day two, Nvidia, even though the equity markets took pressure and a sell down yesterday, Nvidia was up nearly 2%, continues to rise this morning on the back of Bank of America reaffirming their call on that. Russell 2000 up by 0.2%. The PPI just wasn't as brutal as the market had anticipated. Look, we're going to continue with Fed speak today. Barkin, Collins and Bostic all delivering remarks. We count down to the earnings for JP Morgan, Wells Fargo and Citi tomorrow. On Monday, it's Goldman Sachs. They will deliver their numbers. And fresh economic data, including the retail sales, hits the tape. Finally, Tuesday, it is more bank earnings. Bank of America, Morgan Stanley. That was Countdown to the Open, right here on Bloomberg. Good morning.
We are 30 minutes into the U.S. trading day on this Thursday, April 11th. Here are the top stories we're following. A public fund for private markets. The Destiny Tech 100 Fund is a publicly listed closed-end fund that invests in private tech startups, and its stock has skyrocketed as investors pile in. How does the company's CEO feel about the huge premium? We'll ask in just a couple minutes. The EU's approach to big tech. European Commission Executive Vice President Margrethe Vestager joins to discuss her current trip to the U.S. and the push to regulate tech companies and artificial intelligence. And KKR's path to $1 trillion. Bloomberg TV's Lisa Abramowitz sits down with the co-CEOs of KKR following the firm's investor day. We'll bring you their exclusive conversation live later on this hour. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at stock markets on this morning, and you can see it's pretty quiet. You have the S&P 500 unchanged right now. Big tech trying to stay green. The NASDAQ 100 currently up about 0.3%. Of course, we did have PPI coming in hot, but actually a downside surprise relative to expectations. That's giving a little bit of relief to the bond market. You can see the 10-year yield. It is higher, but only to the tune of about 2 basis points, and that's relatively quiet relative to what we've seen earlier this week. But of course, all eyes are on AI in Amazon's annual shareholder letter. Andy Jassy saying the company's cloud infrastructure will become an essential part of the AI boom, saying, quote, "We're optimistic that much of this world-changing AI will be built on top of AWS." Anurag Rana of Bloomberg Intelligence joins us now with more details. And it makes sense that Jassy would, of course, want that to happen, Anurag.
Yeah, and one of the things everybody needs to remember is in cloud infrastructure, Amazon has the commanding lead. It has over 40% of market share in that particular area. The thing that they don't have right now is a very close relationship with OpenAI, and OpenAI's ChatGPT is the buzz over the last 1.5 years, which runs on Microsoft Azure. So which is why you can see the numbers flow into the Microsoft cloud, but not so, at this point for AWS or Google.
And it was interesting, of course, again, the focus on AI. It makes sense relative, you think about what they see as the future. But did anything else in this letter stick out to you?
Yeah, one of the big thing is they're trying to differentiate their way of selling Gen AI versus Microsoft. And what they're basically saying is we will give you all the picks and shovels and you have to figure out what you're going to do with it in terms of a lot of choices, whether it's different large language models or different services. So it's up to the companies or enterprises to develop their own solutions. It's slightly different than what Microsoft is doing right now. Now, I think Microsoft is also going to offer similar services. I think they already do. But other than Gen AI, the one of the things that our retail analyst Poonam basically reached out to me and said that they are really focusing on retail profit, and we think there is some optimization over there, and as well as the revenue that they generate from advertising that should help retail profitability down the road.
All right, Anurag Rana of Bloomberg Intelligence, really appreciate the breakdown. Thank you so much. And let's move from Amazon to actually a public company that invests in private markets. We're talking about getting public access to private companies. It's the mission for the Destiny Tech 100, a new fund that lets individual investors invest in private startups such as SpaceX, such as OpenAI. It trades under the ticker DXYZ, and since its debut at the end of March, it's up just below 500%. Here with me now for more is Sohail Prasad. He is the Destiny Tech 100 CEO and founder. Great to see you in person.
Thank you for having me, Katie.
We have to start with the price action. You went public in late March. You're up 500%. At one point, that number was more than 1,000%. And even by meme stock standards, that is truly wild. What do you make of the price action so far, and who's driving it? Is this retail investors or is this institutions?
We've seen interest from across the board. When you look at it, it really feels like this is a moment for the public markets and the private markets coming together. And so this is just, over $2 billion of volume in the last 10 days alone.
Yeah, it definitely has been staggering to watch. And it's interesting, too, because there are other funds that are trying to do this currently and in the past, basically bring that private equity-backed startups to the public. You have the ARK Venture Fund, for example. What differentiates DXYZ?
The biggest thing when we were creating DXYZ is thinking about how do we create a product that anyone can access from the comfort of their brokerage account that has the protections and liquidity of the public markets. And so the challenge with a lot of the pre-existing funds that have been out there is they don't actually have intraday liquidity. So people can't buy in, sell when they need to, and participate like they're used to in the public markets.
Well, with that intraday liquidity, of course, you have a lot of volatility, but you also have a huge premium. There's a lot of focus on that premium. Just to lay out some numbers for our audience, your last calculated net asset value was $4.84. Shares currently trading above $50. If you put that another way, you have $54 million of assets, a market cap of around $600 million. Does that concern you at all?
I think this is a discovery process. We've just been in the market for 2 weeks. And so over time, the market's figuring out, wow, it is possible for the first time to have access to these kind of companies. And as more and more people are learning that, I think there will be more participants in the market and more stability over time.
And of course, you calculate your NAV quarterly, but do you have any sense of whether your NAV has changed meaningfully since the end of last year?
Don't have anything to share there until our first quarter results are announced.
Okay, so we'll have to stay tuned there. But let's talk about the path forward from here, because I'm sure you've read it, but Matt Levine suggested in a column yesterday that Destiny should issue more shares to capitalize on this moment and also lessen the premium that exists right now. Are you considering a move such as that?
We have all the tools of the public capital markets available to us. I can't share any specific plans, but there's a lot of opportunity. When we decided to list the Tech 100, we have 23 companies right now, and we're building towards a portfolio of 100.
Well, let's talk about that a little bit more. Like you said, 23 right now. You would like to get to 100. When might you get there, and what's your criteria for adding more companies to your holdings?
When we created the fund, we wanted to create something that looked as close to beta exposure to the private markets as possible. And so what we did is we set up our eligibility and inclusion criteria, which we publish publicly. And then over time, we'll look to invest in all sectors in kind of late-stage venture-backed tech.
And how do you actually obtain the ownership in these privately held firms? That is one of the big questions buzzing around Wall Street right now. Do you do that through private stakes, trading platforms? Do you invest directly? How do you actually do this?
All of the above. We've made sure that we have a flexible mandate. So we actually in the last few weeks have had a ton of founders of unicorn companies reach out to us wanting to be included in the Tech 100. We participate in the secondary markets. We invest in late stage rounds. So we try to get best execution for our portfolio.
What do you think that shows that you actually have companies approaching you right now? Is that a desire for liquidity at this moment?
No, it's more a reflection of the fact that there's a journey between a company's private existence and its public existence. And so we're seeing people want to help bridge that gap, start educating the market as to what their business is as they think about their path to public.
Interesting. And of course, you have companies staying private for a lot longer, so that makes sense as well. But also when it comes to how you actually obtain these stakes in these private companies, it's been written that, of course, you also do it through forwards contracts. And there's a lot of questions as to whether you could have companies come back and ask for their right of first refusal there. How are you approaching and thinking about that?
Our role, a lot of change makes people uncomfortable, and that's part of growth. And so our role right now is educating companies, educating the public as to how we access these companies. Over the long term, having the flexibility in our mandate means we can look at all kinds of transaction structures to get the best execution possible. Again, whether that's primary, secondary, or through other means.
Are you worried about potential litigation?
No, I think a lot of people are excited to see this exist.
And let's talk about your actual holdings right now. So as we discussed, you have 23 right now. By far the biggest is SpaceX, 30-something% of your portfolio. And then the next biggest holding is, I think, around 10% or so. Is that a reflection of the availability of SpaceX shares, or is that a conviction that you have?
No, it's a reflection of the fact that the portfolio is still being built.
Okay.
And so over time, as we continue to add names, that will fluctuate until we reach a more steady state around 100 companies.
Once you get to that end goal of 100 companies, how will you weight the portfolio? Will this be equal weight? Will this be some version of market cap?
Yeah, we definitely keep into account market cap. We're going to weight into two sectors. One piece is, the $7.5 to $10 billion plus companies. And then the other half will be the $750 million to about $7 to $10 billion companies.
And so, like you said, you see a lot of opportunity in this space. You do have others pursuing something similar, the ARK Venture Fund. You, of course, are publicly listed. You can trade it as an equity. How big do you think this market could be? Of course, this opportunity for retail to invest in private companies when you say 5 years in the future or so.
I think it's massive. I think there's going to be a lot of people in the industry that are looking at this right now being like, this is has the potential to be a better product for venture. Over the last decade, a lot of venture has sold beta exposure as alpha and charged 2 and 20. And so in the long run, it's not just individual retail investors, but also institutions that can have a liquid product that invest in the private markets.
Do you have any concerns, though, about whether, individual investors should be in private companies? Of course, some would argue that these companies are private for a reason, that they should be seasoned and come to the public markets first before you open up broad access.
Yeah, that's one of the reasons why it's valuable that we're a portfolio of companies, not any one single company. And we kept that in mind when deciding how to build this product.
And before I let you go, we were taking a look at some of your filings. We found one from April 8th. It looks like it shows that you personally have sold about $5 million of stock. Is there any message for shareholders to take away from that?
Yeah, so actually that was our parent company, Destiny XYZ Inc., that sold stock. And it's super important for us to be independent. Mm-hmm. And so that actually for us allows us to grow our team, grow our products and offerings and serve the Tech 100. And so there's been a lot of speculation on that, but for us, we're trying to build a real profitable business. We actually brought Destiny Tech 100 to market with 0 banks or financial advisors involved, 0 distributors. And so we're trying to build a product that's actually interesting to people rather than another financial product that's just sold.
Well, just taking a look at the shares, definitely you have caught a lot of people's attention and they find it very interesting. Really enjoyed this conversation. Glad that we could make this happen. Our big thanks, of course, to Sohail Prasad of the Destiny Tech 100 Fund. And be sure to tune into my new podcast, actually, with Matt Levine, as I mentioned, of Bloomberg Opinion. It's called Money Stuff. It premieres tomorrow, and new episodes will drop every Friday at 2 p.m. Eastern. Now, coming up on this show, though, we have Margrethe Vestager, the Executive VP of the European Commission. She joins us to explain why she thinks AI could be as disruptive as atomic weapons. This is Bloomberg. The EU's top tech regulator, Margrethe Vestager, says that AI could be as disruptive as the atomic bomb. Big tech and AI regulation are at the top of the agenda today as EU officials gather in Washington with leaders in government and technology. I'm pleased to say that joining us now is Margrethe Vestager. She is Executive Vice President of the European Commission. Joining me, too, is Bloomberg's own Anne-Marie Hordern. And Margrethe, great to have you with us. Let's start, of course,
Thank you very much for having me.
Really looking forward to this conversation. I want to talk about the EU. It said 3 months ago that it was going to investigate the relationship between Microsoft and OpenAI. Are you able to share any findings of that probe so far?
Well, not so far. We're also comparing note with other authorities, because obviously it's top of mind for us to make sure that the market stays competitive when everything gets fueled by artificial intelligence. It's going to change the marketplace.
Do you have a timeline at all, Commissioner, when we could potentially see some movement on this?
No, we don't have a fixed timeline. Of course, we want to produce results as fast as possible, also for the involved companies, for their benefit. We'll be getting there soon, I think.
So we're talking about Microsoft and OpenAI, but of course they're not the only players here. You have Amazon actually with a big, almost $3 billion investment into Anthropic, which of course competes with OpenAI. What do you make of that? Is that something that you're looking at as well?
Well, we will be having, a vigilant, keen attention to what is happening in this field. We see a lot of entrenched market power when it comes to technology, and it's really important that now when we have technology, which is not just a new technology, it's basically a new world that we're looking into, that we make sure that it's a competitive new world.
You just recently, under the DMA, went after 3 big U.S. tech companies. And to be honest, Commissioner, 3's a crowd. I'm really curious to know which of these you are honing in on. And because a lot of people really seem to think it's Apple, where the EU has a lot of problems with.
Well, what's the point of the Digital Markets Act is to open the market, to make sure that more businesses can get to their customers, so customers have more choice. So obviously we are looking at getting out of self-preferencing, so that you do not, if you, for instance, have a Google search, and you do not just get a Google product. And we're looking at how businesses can get a real relationship with their customers, so to get rid of the anti-steering that we see quite a lot, and people have choice if they want to stay in the Apple payment environment or they want to have a direct and sometimes cheaper relationship with their service provider.
Well, among those 3, Apple, Google, and Meta, do you have a priority target?
Well, we have opened these 5 cases because we think these are very important. We may have more cases in the pipeline, so we have given retaining orders for what may be evidence once we're moving forward. These 5 cases, they are all priority. We think that they are absolutely key if our suspicions are confirmed. That we get compliance, because this is what opens the market, and that's the basic idea of the Digital Markets Act, for many more businesses to have a fair chance to get to their customers.
Commissioner, there's currently a lot of bipartisan support in Washington to rein in big tech. It's one of these rare policies where you have the likes of Elizabeth Warren and J.D. Vance lining up behind the same issue. Do you think potentially, given this bipartisanship we see in this space, and given the fact that we also see the FTC going after these companies as well, that the U.S. may do the work for you and assuage the Commission's concerns?
Well, I don't think so. Everybody will have to do their own job, but I really appreciate when things are moving forward here, because we are so much stronger when we are a bigger community. So if the U.S. would join in full, also with a legislative background, I think that would be great. That would be an even faster way to make sure that the digital market serves consumers well.
Well, following up on that point, how are you thinking about the U.S. as a partner in some of these efforts? What degree of coordination, of talking is there between the 2 sides, of course, as you go after big tech and AI?
Well, actually, I think the relationship today is better than it has been for decades. Within the framework of the Trade and Technology Council, we agreed very early on the approach to artificial intelligence to be risk-based. We just very recently decided to see, can we set common standards? For instance, what is actually red teaming? What do you have to do in order to tick that box? What is watermarking? How can you tick that box that we as consumers can see what is the fake, what is the deep fake? So the relationship is very close, it's very good, and I think that increases the chances that we can actually have an open competitive market that promotes innovation also when it comes to these services.
There's one U.S. company that the EU has yet to go after, that many are waiting, that potentially could be the next one, and that's NVIDIA. Do you plan to open a formal probe into this company?
Well, even if we did, I would not share that with you. That is kind of the things that we keep
Well, are you
to ourselves.
concerned about their chip market dominance at all?
Well, I would not comment on that.
Okay. All right. Well, I guess that potentially means this is one of those wait to be seens. I would love to also get your... I'm kind of taking that as potentially that's a yes, but if you don't want to comment, we'll leave it there. Katie and I would also like to get your thoughts on what is going on with China, because this week you also opened up a probe into the China wind markets. We have seen for years China dump solar technology onto the European market. What have you learned from the past when it came to solar that now you're looking into when it comes to wind?
Well, we recognize what we see as a Chinese playbook, inviting European companies to joint ventures, transferring technology, heavy Chinese subsidies in the Chinese market to build capacity, closing off their own markets towards foreign businesses, and then to start export at prices which are basically not for anyone to compete with. And the result in the solar market is that by now, only 3% of installed capacity when it comes to solar is actually produced in Europe. And knowing that you have been played, of course, teaches you that you need to watch out to be much more observant and take better action. So we're using both our trade tools and our tools that comes with the foreign subsidies regulation in full in order to restore fair competition.
Where does this leave EVs then? Because this is something that the Biden administration is keenly focused on, and they continue to talk about the fact that there might be more tariffs on Chinese EVs coming into the United States. Where are we with the EU probe on Chinese electric vehicles?
It's my colleague Valdis Dombrovskis who's leading that probe from a trade perspective. It's a priority case for them, obviously, because Europe is one of the big open markets when it comes to EVs, and the Chinese market share in Europe is increasing quite dramatically. So this is absolutely top priority, but they do not have the final results yet.
I do want to move from China to Russia because certain EU nations, they're continuing to import quantities of Russian LNG. And the Commission, you had previously had concerns that Gazprom had artificially restricted supplies to really inflate prices. Can you share what the status of that investigation is?
Well, that has been a bit quiet for quite some time because of the war, because things are really politically steered by now. Of course, we see the inputs, but I think what is much more important is that now you've had a full diversification in Europe when it comes to gas imports, both pipeline and LNG. By now, we buy so much more LNG from American producers, and obviously very thankful for that supply coming into Europe, because that strengthens our independence and it cuts the dependency that we used to have on Russian supply.
Commissioner, it's not lost on me that you're talking about thanking the U.S. You're sitting in Washington, D.C., yet the Biden administration is having a pause now on LNG permits. How concerning is that to Europe's national security, given the fact that Europe has pretty much replaced Russia for your LNG imports?
Well, as far as we know the consequences of that decision, it doesn't affect the imports that are happening and the contracts that has been signed. So we think that we're good, also because here we do not only rely on the U.S., we have many more, both from Norway to some more Middle Eastern suppliers and African suppliers in this. Because diversification, I think that is the new black. Everyone wants to know that if something happens somewhere, that you're still safe to give your supply from other sources.
I just want to also end with this potential of the U.S. election. I know this is something you're not going to want to comment on at length, but the former President Donald Trump is the front runner, is the nominee, and potentially this time next year, we will have a Trump as a president. Next time you come visit the United States, potentially. He once said that he, quote, that you, quote, hate the United States and that you're perhaps, quote, worse than any person he's ever met. How do you plan to work with a Trump 2.0 administration?
Well, actually, I have never met Donald Trump. So I don't know how he built this assessment. And I think I have proven beyond reasonable doubt in the workings within the Trade and Technology Council and with colleagues on the competition side of things that I have a very, very strong, if not love, then like of the United States.
All right, Margrethe, I think that's a good place to end it. Really appreciate your time today. That, of course, is Margrethe Vestager. She is Executive Vice President of the European Commission. And, of course, our thanks to our own Bloomberg's Anne-Marie Hordern. Meanwhile, you take a look at these markets about an hour into the U.S. trading day. It's a down day. You take a look at the S&P 500. We are currently off by about 0.3%. Again, big tech, it's struggling to hang on to those gains. The NASDAQ 100 up by about 0.1% or so. Of course, we did get PPI this morning, and it came in below expectations, but of course, it was still pretty hot relative to recent history. You take a look at the bond market there. It's a quiet day, but it's getting a little bit noisier. You can see the 10-year yield now picking up about 4 basis points. We are nearing 4.6%. Now, coming up, tax changes coming in 2025. We're going to discuss how it could impact the U.S. economy. Natasha Sarin, she is an associate professor at Yale Law School. She joins us next. This is Bloomberg. All right, it's time now for our daily Wall Street Week conversation. And today, we're talking taxes. Some tax cut provisions are set to terminate by the end of next year. And here to talk about the potential implications for the economy is Natasha Sheryn. She is Yale Law School Associate Professor, along with Wall Street Week's David Westin. David, it's never too early to start talking about taxes.
Well, particularly with tax day coming up on Monday, right?
Yeah,
it's April 15, so it's just fitting. Natasha, great to have you here in New York. So first of all, talk about the Budget Lab, because this is something new that you just created. Just describe what you're doing.
Yeah, well, we're incredibly excited to be launching this week and launching right around tax day and into an incoming tax debate. Our kind of focus is oriented around trying to provide policymakers the tools they need to do effective policy analysis. And I spent the first 2 years of the Biden administration in the Treasury Department, where I was very lucky to get to be part of a bunch of legislative conversations that were happening around what ultimately became the CHIPS Act, the Bipartisan Infrastructure Law, Build Back Better, which morphed into the Inflation Reduction Act. And through the course of all those conversations, I realized the importance and the centrality of what are called budget scores in the legislative process. And these scores are essentially like cost estimates. They're like, how much is a particular spending proposal going to cost over a decade? How much is a particular tax provision going to raise over a decade? But for a lot of stuff that I hope Katie and David, you guys would be enthusiastic to see the government do, things like investing in a fully refundable and expanded child tax credit that lifts 19 million kids out of poverty, or investing in emissions reduction through things like the green energy subsidies and tax credits that were passed in the Inflation Reduction Act. The right way to think about those benefits isn't through the lens of just whatever the costs are over 10 years. And so what I want to build with my team, and I co-founded this with two former colleagues, Martha Gimbel and Danny Yegan, who's an economist at Berkeley, is really the infrastructure to help policymakers think more holistically about what the costs and what the benefits of particular provisions actually are.
Well, let's talk about what you've put out from the Budget Lab so far. Of course, looking at the expiration and taking a look at different scenarios here. You have full extension, you have partial extension, and then you have a tax plan proposed by you and a colleague. What would full extension look like when you think about the effects on GDP, for example?
So full extension is the idea of basically fully deficit financing the $3 trillion of Trump tax credits that are set to expire in 2025. And what you see that happens if you do a deficit finance tax plan of that size is that in the short run, sure, you're going to get a little bit of demand boost because after-tax incomes are going to go up. But in the long run, you're seeing really sizable costs for households. And those costs have to do with higher interest rates, more inflation, and all of that is demonstrated in the model. You can see that we're going to cost the American economy in terms of growth over the course of the next few decades hundreds of billions of dollars if we don't find a way to pay for whatever provisions that policymakers decide that they want to extend.
Well, that's the key thing, is that paying for them is the issue. And if you look at the chart, it's pretty dramatic that you have on the website, actually. The GDP, real GDP, really goes up in the early years.
Totally.
If they extend the tax cuts, it really goes down in the out years, and it does the reverse, actually, if they don't extend it. How much of that is just because of we are going to have to borrow so much money that perhaps we can't even afford?
That's exactly what it is. So baseline, if you don't do anything with respect to extending the expiring provisions of the TCJA, so you just say let them all expire, debt to GDP ratios are going to rise to 116% over the course of the next decade. If you're in a situation where you say instead, let's extend all of them but deficit finance them, this full extension model, debt to GDP ratios are going to rise to over 130%. And those types of fiscal costs bear on households directly. We're already seeing it in the form of higher interest rates that households face and inflation that households are facing. And so I think it's really important for policymakers as they think through this debate that's upcoming to try to grapple with, and we try to in our modeling, help them grapple with what some of those consequences might actually be.
But is that how politicians think? I mean, if you take a look at what you've found when it comes to just extending some of these tax cuts, that leads to higher real GDP levels in the short term. We're talking about the short term here, but if you're running on a 4-year cycle, I mean, maybe you care about the short term.
So I teach corporate finance at Yale, and I teach my students how do corporate executives make decisions. And one thing I say is if you're thinking about whether you're a CEO or you want to buy a new factory, you kind of think about, okay, it's going to cost me something today to buy my new factory. But in the long run, what I'm going to see is maybe the new factory helps me produce more efficiently or helps me launch a new product line. And so certainly like this cost-benefit trade-off has to be central to my decision-making process. And it's strange that the government doesn't have that centrality with respect to how it thinks of both sides of the ledger. And I'm a little optimistic, Katie, that if we develop the tools and the infrastructure, which is what the Budget Lab is doing, to help them do this work, they'll actually find it to be a useful input into their process. Because you can say that investing in kids today, in 30 years, those kids are more productive members of the labor force, and that pays off real returns, and that's something that we should care about.
That cost benefit has certainly ramifications across the entire economy, but it also has disproportionate effects on various percentages, quintiles often we divide them into. Give us a sense of what happens if you renew or don't renew the Trump tax cuts in terms of households.
So the nature of the way the Trump tax cuts are designed is they provide the biggest benefit for those at the top. And so if you look at the average benefit that the average cut that the top 1% is going to see if we just fully extend these Trump tax credits, that's going to be on the order of magnitude of around $50,000. You compare that to the very bottom of the distribution, it's a few $100s. So from an inequality perspective, if you just fully extend the Trump tax credits, the Trump tax cuts, what you're going to see is more than twice the gain in after-tax income. We have a chart, so maybe you all are looking at it. More than twice the gain in after-tax income for those at the very top relative to those at the very bottom. And it strikes me that, like, as we think about sort of high and rising inequality in this country, that's something that policymakers care about too, is understanding how can they help reach exactly the most vulnerable households.
Well, Natasha, unfortunately, we have to leave it there. Really enjoyed this conversation. Hope to have you back soon. Our thanks, of course, to Natasha Soren. She is Yale Law School Associate Professor. And David, who else do we have coming up?
Well, tomorrow we have a twofer, actually. We have the former head of the World Bank. He's Bob Zoellick. He's going to talk to us about what's going on with trade policy and manufacturing in the light of what we're dealing with Nippon Steel as well as U.S. Steel. And then we're also going to talk with the former head of IBM, Sam Palmisano, about the right way to regulate generative AI. That's all coming up tomorrow on Wall Street Week at 6 p.m. Eastern Time.
All right, a lot to look forward to there. Our thanks, of course, to David Lustin. This is Bloomberg. All right, it's time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, we have CarMax losing speed as it reports profit and sales that fell below estimates in the fourth quarter. The used car dealer citing inflationary pressures and vehicle affordability challenges as the main drivers for its disappointing performance. Next up, Rent the Runway back in fashion as it tops earnings expectations in the fourth quarter. The clothing rental company reporting that membership loyalty rose 10% thanks to improvements in its digital user experience. And finally, we have DoorDash getting an upgrade at MoffettNathanson to buy. The firm had previously downgraded the food delivery service because of concerns that the restarting of student loan repayments would have a negative impact on DoorDash. Just goes to show, never underestimate the spending power and the appetites of college students. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. I do want to take a look at markets at this moment because, again, it's a down day on Wall Street. You take a look at the S&P 500. It's down only slightly, about 0.2%, but you add it together and the S&P 500, it's down about 1% for the week so far. That follows, of course, last week's decline as well of about 1%. So clearly April not off to a great start for the big index, but of course it was quite a start to the first quarter or so. But let's also talk about the NASDAQ 100. You have big tech up about 0.3%, really holding on there, even as, of course, you have the S&P 500 wobble. We got PPI this morning. It was a downside surprise coming in below estimates, but of course it was still pretty hot. And you can see that sort of working its way through the bond market right now. The U.S. 10-year yield, it's up about 3 basis points. Of course, we're talking about a yield of almost 4.6% or so. So we're going to continue to keep an eye on that one. But coming up, an exclusive interview with the co-CEOs of KKR as they aim for $1 trillion in assets under management. That's next. This is Bloomberg.